Joshua Long is an associate professor of economics at the Indiana Institute of Technology in Fort Wayne, Indiana. Prior to joining the faculty at Indiana Tech, he served on the faculty of Ivy Tech Community College for 9 years. His educational background includes a PhD from Capella University and an MA in economics from Walsh College. His presentation is entitled "The Aftermath of the Bubble." I present to you Professor Joshua Long.
And my topic that I wanted to address was the aftermath of the bubble. We've heard a lot about the various financial bubbles and financial crises which we've gone through in the last couple of centuries. How many of you experienced firsthand the financial crisis of 07 to 09? Show of hands, who lost some money during that? Okay, quite a few people experienced that firsthand. I've spoken to many people. Just to kind of take a look back, the last time I was here at one of these symposia was in 2011, and in preparing for this presentation, I actually went back and dug up some of my notes. I was trying to put myself kind of back in 2011 because a lot's happened in 3 years. A lot's happened, but a lot has not happened at the same time. And a lot of these things here are fairly obvious. We saw the worst recession, the worst downturn in the business cycle since the Great Depression. Obviously, the financial crisis, we saw a record number of bank failures. If you go to FDIC.gov, the Federal Deposit Insurance Corporation, there's a list of all the banks that collapsed or that were closed down during the financial crisis, and also in the wake of the financial crisis. And it's drastic, it's dramatic. When I teach micro or money in banking, that's always a fun list to pull up and listen to everyone gasp. The stock market decline, obviously we've heard quite a bit about that this morning. There's no reason to go on about that. Also the collapse in real estate markets. The good news, obviously, that those are starting to rebound. They seem to have bottomed out and seem to be coming back. We've seen unprecedented, or perhaps historically precedented, types of government economic stimulus, both fiscal and monetary. We saw the American Recovery and Reinvestment Act of 2009, all of the money that went into infrastructure and things of that nature. And we've also, and one of the things that I've been particularly interested in lately is looking at trends in inflation or deflation. I believe Professor Vereiser will be speaking more about that topic in just a little bit. But what I wanted to talk about was, where are we now? And just kind of take a look at some of the official views of where we're at currently. The last couple of months I've found myself at a record number of conferences, attending or speaking with different people, and I've seen some interesting snippets that I thought would be fascinating to pass along. So where are we today? Stock market has rebounded happily. We've discussed that a bit this morning. The news that's good and not so good at the same time is that the economy has rebounded. It has rebounded, but not at the average rate. Not at the average rate. And I'll show some data on that. We're still seeing higher than average unemployment rates for any number of reasons. And then also we see continued or continual expansionary monetary policy in this country, not only at the present but also for the foreseeable future. And then once again there comes the question of inflation. Where is it going? Where is it going? And even in the last 24 hours I've heard some very fascinating things about that. Gross domestic product, as you know, for better or for worse in the economics establishment, is the main measure or metric of economic activity. If you want to learn more about that, take any macro class and you'll learn about GDP until you're green in the face. Over the last half century, after we discount for inflationary trends, obviously inflation over a period of over the last century has been positive. We do have minor periods of deflation during the Great Depression, during the Great Recession of 07 to 09, but overall inflation continues to increase, even if it be mild. So whenever we take a look at economic growth, what do we have to do? We say, okay, the economy's grown at 5% or whatever, but we have to always discount for inflation. What does inflation do? It distorts anything that's expressed in monetary terms. So over the last half century, the US economy has grown at about, after discounting for inflation, at about 3.5% annually. If you actually take a look at the actual graph, it's rather zigzaggy. It kind of reminds me of some of the roller coasters at Cedar Point. How many of you have been there before? Cedar Point, yeah, favorite place to go. Some of those coasters are pretty wicked. Gross domestic product it's a pretty wicked ride. The bad news. So the good news is that what? The economy has rebounded. The bad news is that our current trend is below the average for the last half century, and the official predictions are calling for a slowdown in economic growth looking into the long term, which is perhaps not the best news. It's not the best news. The next graph simply shows gross domestic product, real GDP for the U.S. economy from 1990 up to the current day, and then it also shows some official projections from the Federal Open Market Committee, which, as you know, is one of the monetary policy making boards at the Federal Reserve. And you can see what's happened. Well, keep that 3.5% in mind. That's over the last half century or so. 1990 through the Great Recession right here, we're somewhere, the 3.5% is probably a bit on for the last 20 years, that's kind of generous. But over the last half century, that trend has held true. The good news, we've rebounded. We took a pretty steep dive down in terms of GDP, and we're kind of zigzagging in positive territory between 2 and 3%, maybe getting down less than 2 at times. But the part that I find rather fascinating to myself professionally is the prediction for the future. For the longer run, as the FOMC puts it, and I have to credit a colleague at the Federal Reserve Bank of Chicago for this graphic and also for this data, but their prediction is to have economic growth at about in the low 2% range. So economic growth, yes, but a slower rate of economic growth. And that has me concerned a tad bit. I know we've been talking a bit about China a little bit. China's the second largest economy in the world. Ever since some of the free market reforms in China, 70s and 80s, China was looking at annual economic growth, at least the official reports, of about 10% per year, 9 to 10%. But lately, even the official reports are slowing down. The last figure I saw, I believe, was in the 7.5% range. So we seem to have, at least in the world's 2 largest economies in the world, a slowdown. That's not what you want to see after you go through a catastrophic event like the Great Recession of 07 to 09. Ideally, we'd like to see what? A pretty good rebound. The next graph shows some of that same information, but there's also a market prediction for where gross domestic product, where the economy is supposed to go. This shows somewhere in the range, of the mid-2s to maybe 3 in the next year or two. But notice that that even the official predictions are calling for slow growth, and even the market predictions are calling for slow growth for the next couple of years. This has me a little concerned. I really wonder what the Great Recession did to the U.S. economy. Did we turn by some major, turning point, as it were, in U.S. economic history? Only time will tell. Only time will tell. Do we know what will happen in the future? No. No. But the predictions are not overly optimistic, kind of lethargic at best. We've spoken a little bit about the activity of the Federal Reserve. During my last presentation in 2011, I walked through some of the extraordinary types of monetary policy stimulus that the Federal Reserve had attempted to put in place in order to try to stimulate the economy back into some form of activity. Some of these had occurred at that time. We've had several rounds of quantitative easing. We've had Operation Twist, and currently we're in the middle of quantitative easing round number 3. We hope that at least the hope is that this latest bout of monetary medicine, as it were, will help to hold off any risks that exist in the economy today, and hopefully encourage investors and consumers to engage in activity. Whether or not that will actually help or happen, I'm not sure. This is half of the balance sheet of the Federal Reserve at present. So at the very, very start of the recession, or even right before the recession, you can take a look at some of the assets that the Federal Reserve owned. After the end of the Great Recession, actually, let's see how many years have gone by. Let's see, 09 to 010. What is that, 4 years? 4 or 5 years later? The Federal Reserve has assets of somewhere in the range of $4 trillion. This represents the Federal Reserve engaging in monetary policy of different types, buying up various types of assets and injecting liquidity into lending markets. Rather unprecedented. Here's the result. Here's the result. This comes from the Federal Reserve Bank of St. Louis. For any of those of you who have taken macroeconomics, in the chapter on fractional reserve banking, you will probably remember that banks are able to make loans based on the amount of their excess reserves. Banks hold on to a certain amount of their deposits. The rest of the money is then able to be lent out, and then that, of course, can create new money multiple times over. This shows the amount of excess reserves of lending institutions in the U.S. economy. And I simply took it back to the mid-'80s. Between 85 and 06 and 07, can you even see the line? Can you even see the line? No. Banks had what? A nominal amount of excess reserves. Was lending occurring under fractional reserve banking? Sure. Sure. Loans are being made in different amounts. And then all of a sudden, during the Great Recession of 07 to 09, because of quantitative easing, because of the various and extraordinary actions of the Federal Reserve, large amounts of liquidity, of funds, were injected into lending markets, reflected in part, I think, by the extraordinarily low interest rates that the Federal Reserve sets, primarily the federal funds rate and the discount rate, which are still extremely low. And going back to our basic macro terminology and coursework for a moment, we know that if banks actually lend all this money out, what could be the result? More bank deposits, more money in the economy. If everything else is constant, inflation could be the result from a textbook standpoint. However, that's not the official view at present. And this is what has me curious. This shows the Consumer Price Index, prices for consumers, or inflation measured from the perspective of consumers in the U.S. economy, 2000 through the current day, with also projections into the future. We saw a bit so positive territory shows inflation year after year after year after year, which is the long-term trend. And once in a great while, we see little bits of deflation occur. Not too much, though. During the Great Recession, we had a pretty good drop in consumer prices. But take a look at what the predictions are for the future. At present, inflation is around 2%, as measured by the Consumer Price Index. Rather mild. Look at the predictions for the foreseeable future. Fairly mild, 2%. Is that surprising? Not terribly, because the Federal Reserve has a relative target for inflation of about 2%. Last night, I was kind of bored, so I turned on the television late at night, which is kind of dangerous at times. I was listening to Charlie Rose. I was pretty tired, so I wasn't really paying a whole lot of attention to what I was watching. And then all of a sudden I noticed that his guest was Christine Lagarde, the managing director of the International Monetary Fund. I'm like, oh, that's kind of interesting. And I'm not sure how recent the interview was. It may have been it was probably rebroadcast. I doubt she was being interviewed at 11 o'clock at night. But they were discussing inflation and inflationary trends, not only for the U.S. but also for the world. And she started to speak a little bit about the conventional view that inflation can have negative effects for the economy. Many of us have learned about those things. It destroys the purchasing power of money, destroys the value of savings. But at the same time, she presented a different point of view, which made me really pay attention, because you don't hear this all that much. But she started to talk about some of the positive benefits of inflation. It made my teeth itch a little bit. Having been a graduate of the MA program at Walsh, we tend to look at inflation as being a more negative phenomenon. But it was interesting insofar as here you have one of the leading finance and economic powers in the world, the head of the International Monetary Fund, that international organization that goes in and helps to bail out countries when they're in times of difficulty. Talk about the positive benefits of inflation. I'm not quite sure that's an example of contrarian thinking of what Mr. McGrath was speaking about, but at least that would help me to kind of understand where some of the officials who are in charge of influencing monetary policy, either at the international level or at the domestic level, where they're coming from. And I believe this is one of my last graphics. This is, and then after I heard about Ms. Lagarde's comments, I actually found this on the Wall Street Journal website, and this comes from the International Monetary Fund website, and it simply gives projections for inflation and also some historical data for the world economy, advanced economies, and also developing economies. Obviously, you can see that for the world economy, inflation is expected to be kind of where it's at. For advanced economies, there's expected to be a slight increase in inflation, but in emerging or developing economies, and some of those economies around the world that may not be so prosperous, they're looking at a trend in maybe a slowdown in inflation a little bit, If you read the latest FOMC statement that came out just a few weeks ago, in March, the Federal Reserve has announced that it is planning to continue with quantitative easing, round 3, buying more assets, financial assets out of the economy to the tune of tens of billions of dollars each month. However, that trend appears to be slowing. And so instead of buying $30 or $45 billion worth of assets each month, they're buying perhaps, say, $20 billion each month. Still expanding the money supply. Where will inflation go in the future? We don't know. Austrian economics would suggest that and not only Austrian economics, but also other economists like Friedman and others, they would suggest that an expansion of the money supply, the monetary base, could potentially lead to continued inflation in the future. Where will things go? We don't know. Economic action is the source of all economic activity. Without humans, we don't have an economy. So let's cross our fingers and hope for the best. Thank you.